To our floor show, Omnia Family Wealth co-founder Michael Wagner says, do not ignore the bond market's warning that the stock market is heading for rough waters. He joins us now along with TJM Managing Director Trader Chris Robinson. Great to have you both. Michael, let's get right to it. Nobody seems to have a problem going into this weekend long, and Monday's sell-off frightened off few, if any, investors. So what is behind your worry?
Sure. Thank you, Liz. I think what we're seeing, as you mentioned, is the bond market is telling you something very different than the stock market. We're very near historical highs today. And when we're looking at yields, what we're seeing is a very muted picture for growth. So you're getting very mixed messages from the two markets.
Okay, you're saying muted picture for growth. We just had David Kelly yesterday from JP Morgan on saying he is expecting 10% GDP for the quarter. You know, what are you talking about? I mean, we're looking at strong growth, are we not?
That is what David Kelly is saying, and what we're seeing from the bond market at least is more muted growth. We have a saying here that S&P is not necessarily GDP. We may have pulled forward a lot of this forward growth expectation, talking about a trailing one-year return in 30% range, well beyond long-term historical averages, and protecting client capital. We start to get a little concerned about that.
Chris, you watch the bond market, you watch the stock market, you're looking at puts, calls for all kinds of sectors. What are you seeing as far as the flows are concerned?
Well, I would say this. I mean, the time to prepare for the rainstorm is when there's no cloud in the sky. So, you know, this is when you want to be making a plan for what happens if, last week we had a 4% break. It was 4% break. You'd have thought that, we were entering into the first week of Armageddon. So you've got to be prepared for that. And with the market at 35,000, 5% move, which, for the last 30 years, we've always been told anything 5% or less, that's noise. So you've got to get ready for, 5% moves like we've just had to become a regular thing. And as far as what's the growth rate going to be and that type of stuff, that's sort of not something that I typically look at. We look at how do we protect these gains and how do we also, look for opportunities. So you have to have a plan to do both. You have to be looking at these rallies as opportunities to take profits and to also protect the possibility that, we have a bigger correction than we had last week.
Okay, so Mr. Wagner, you got to tell me right now, where would you be taking profits and where would you be then reinvesting those profits?
Sure. I mean, look, I think you've got to look at those growthier sectors, your big tech names, your Amazons. If you have something like that in your portfolio, I'd be looking to take your gains there. You could move into some of the more traditional sectors. We like commodities right now. You could potentially look at home builders as well. We're facing a deficit in homes in this country. As far as sectors go, that is where I would be seeing opportunities as well.
Yeah, Chris, you look at a name like Intel, big tech, but that name has been struggling. Yet, wouldn't you think that some of the chip makers would be the place to go since there's such demand for them right now, and yet there is a supply crunch?
You would think that, and if that's your investment idea, I always tell people, you have to have an idea to pull the trigger on an investment idea. The question always is what are you going to do if if you buy it and we have a 10% correction? Are you going to buy more? What's your plan? And I think that's the key. And when we're at these lofty levels, you talked about the gain since last July. How about the gain off the low? The low in the Dow at the panic low during the pandemic was 18,000 and change. So we've already gone up 17,000 points in a year. So at some point we're due for a correction. 17,000 points. So you can't get so excited. I know it's hard not to when we move, a 500 points or 1,000 points. And if we hit 35,000, what's the next goal? Well, it's going to be 36,000. And at that level, to go from 35 to 36,000, it's only, and I put that in quotations, it's only 2.8% more. So we're starting to get up in here where you've got to really have a plan. I can't say that enough. Make sure that you know what you're going to do. If there's a stock that you like, make sure you know where it is you want to buy it.
Yeah, keep that shopping list ready for days like Monday. Yep. Which last really very, very briefly. Michael, Chris, great to have you both. Thank you very much.